Topic: 5 investing mistakes that you look like a fool. Welcome back, fellow investors. Whether you're a seasoned pro or just dipping your toes into the world of investing, there's one thing we all have in common: the desire to make smart, profitable decisions. But you know what they say. Sometimes the best way to learn is through mistakes. Today we're going to delve into 5 investing mistakes that can make you look like a fool, and more importantly, how to avoid them. So grab your notepads and let's get started. Mistake number 1, and it's a biggie: ignoring diversification. Diversification is like the Swiss Army knife of investing. It's all about spreading your investments across different asset classes to reduce risk. If you put all your eggs in one basket, like investing all your money in a single stock or industry, you're taking on a ton of risk. One piece of bad news can send your investment plummeting. But when you diversify, your investments are spread out. So if one sector takes a hit, the impact on your overall portfolio is minimized. Now let me tell you the most common mistake people make. They become too heavily invested in their employer's stock or a single industry they're passionate about. Sure, you believe in your company, but putting all your financial eggs in that one basket is a risky move. It's like walking a tightrope without a safety net. Remember the Enron scandal? Thousands of employees invested their retirement savings in Enron stock because they believed in the company. When the company went under, so did their life savings. Don't let that happen to you. So how can you avoid this mistake? The key is diversification. Spread your investments across various asset classes like stocks, bonds, real estate, and maybe even a little gold. Diversifying doesn't mean you'll never experience losses, but it significantly reduces your risk and makes you look like a smart, well-prepared investor rather than a fool. Timing the market. Mistake number 2 is a classic: trying to time the market. Many investors believe they can predict when stocks will go up or down, but the truth is, it's incredibly challenging, even for seasoned pros. Do you know what they say about market timers? They're like fortune tellers. They're usually wrong, and when they're right, it's more luck than skill. Timing the market involves buying low and selling high. Sounds great in theory, but the market is unpredictable. Trying to predict the exact moments to buy and sell is like chasing a mirage in the desert. You'll probably end up with nothing but sand in your hands. The problem is, when you try to time the market, you're more likely to make impulsive decisions driven by emotions like fear and greed. You end up buying high when everyone else is buying, and selling low when everyone else is panicking. So what's the solution? It's called dollar cost averaging. Instead of trying to time the market, invest a fixed amount regularly, whether the market is up or down. Over time, this strategy helps you buy more shares when prices are low, and fewer shares when prices are high. It's a smart and consistent approach that can make you look like a seasoned pro rather than a fool. Neglecting research. Mistake number 3 is a doozy: neglecting research. You wouldn't buy a car without reading reviews and doing your homework, would you? The same principle applies to investing. Yet many investors dive into the market without proper research. They hear a hot stock tip from a friend or see a flashy headline on a news website and decide to invest without understanding what they're getting into. This is a recipe for disaster. Investing without research is like jumping into a river without knowing its depth. You might get lucky and not hit a rock, but most of the time you'll end up in over your head. To avoid this mistake, you need to do your homework. Understand the companies you're investing in, their financial health, and their long-term prospects. Don't just follow the crowd or invest based on a hunch. Make informed decisions. You don't need to be a financial guru to start investing, but you do need to be willing to learn and research. Trust me, it'll make you look like a knowledgeable and responsible investor instead of a fool. Panicking during market volatility. Mistake number 4 is one that even seasoned investors sometimes fall for: panicking during market volatility. The stock market is a roller coaster. It goes up and down, and it can be a wild ride. But what separates the wise from the foolish is how they react during those turbulent times. When the market takes a nosedive, some investors hit the panic button, selling their investments out of fear. Here's the problem with this approach. Market downturns are a natural part of the investing cycle. They've happened in the past, and they will happen in the future. Selling in a panic often locks in losses, and you miss out on the potential for recovery. So what's the alternative? Stay calm and stick to your long-term investment plan. If you've done your research and have a diversified portfolio, you're in a better position to weather the storm. In fact, market downturns can be an excellent opportunity to buy more shares at a discount. Remember, investing is a long-term game. Don't let short-term fluctuations lead to hasty decisions. Staying the course during market volatility will make you look like a resilient and level-headed investor, rather than a panicked fool. Overtrading. Last but not least, mistake number 5, overtrading. Some investors have a strong impulse to constantly buy and sell, thinking they can outsmart the market with their rapid moves. But in reality, they often end up outsmarting themselves. Overtrading can lead to high transaction costs and tax consequences, eating into your overall returns. It also increases the chances of making impulsive decisions and falling into the market timing trap. The problem with overtrading is that it's often driven by emotions rather than a well-thought-out strategy. You might see a stock making a quick move and feel the urge to jump in, only to regret it later. So what's the solution? Set clear investment goals and stick to a well-defined plan. Avoid the urge to constantly tinker with your portfolio. Instead, review and rebalance it periodically, based on your long-term objectives and risk tolerance. Overtrading not only adds stress, but also increases the chances of losing money. Keeping a steady hand and following a disciplined approach will make you look like a composed and strategic investor, not a frantic fool. So there you have it, folks. 5 investing mistakes that can make you look like a fool, and more importantly, how to avoid them. Remember, investing is a journey, and like any journey, it comes with its ups and downs. But by diversifying, avoiding market timing, conducting thorough research, staying calm during market volatility, and steering clear of overtrading, you can navigate the path to financial success with confidence. If you've made some of these mistakes in the past, don't worry, we've all been there. The important thing is to learn from them and continue to grow as an investor. Make the right choices, and soon enough, you'll be seen as the savvy, well-informed investor you aspire to be. So happy investing, and may your portfolios always be in the green.